Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Joining us now is Todd Jablonsky. He is Global Head of Multi-Asset and Quantitative Investments at Principal Asset Management, joining us from our studios in Hong Kong. So you're normally based in Seattle, I understand. What are you doing in Hong Kong?
Well, Principal Asset Management is having its Summit Series, and we're on a barnstorming tour through Kuala Lumpur, Singapore, and Hong Kong, and it gives us a great opportunity to share out to investors how we're projecting the economic landscape through the remainder of 2024 and into 2025.
So we'll get the monthly activity data later in the week for China. There's been so much focus right now on the various stimulus measures that we have seen Beijing roll out, and a lot of disappointment with some shortcomings. And it strikes me so strange that the CSI 300, with that powerful rally that we had, took us to a high of in around October 8th. We're down 10% since then. What do you think is underneath this?
At the bottom of that decline, I think, is investor skepticism that the stimulus programs, whether on the monetary side and or the fiscal side, are sufficient to stimulate the kind of economic activity required to really lift the world's second largest economy out of a bit of an economic malaise. Notably, I'd note that deflation is really the greater concern than inflation at this point in China. And I think you're seeing investors skeptical of the size of the response, but yet wanting to rely on policy to stimulate the demand for credit. We look at China as a credit demand-driven market, and what we really need is for people who want to borrow money and undertake new projects.
So are you seeing opportunity in the credit space?
Well, we are seeing opportunity in the credit space, not necessarily in China. Within credit, our actual favorite complexes are in short-term investment-grade credits as well as preferred securities. We like the credit and carry in those two groups on the short end of the curve, and on the long end of the curve, it's really long sovereigns, like a long German Bund, a long U.S. Treasury. We think that that's the right barbell approach where you can have income, playing offense on the short end, as well as defense, just in case we get a shock on the long end.
So explain to me how you understand Fed policy impacting the credit markets globally right now.
Well, Fed's been leading the way in terms of a synchronized global easing cycle. It's been remarkable to watch. You're getting cuts, of course, in China. You're getting cuts in Europe, cuts in England, cuts in India. So you do have this synchronized easing cycle, and the Fed's leading the way. Now, what I do note is that you have speculation in the market today around the pace at which these cuts will happen. And therefore, where you see a separation between the expectations of investors and the actual actions of central banks, that's causing more rate volatility than we typically have in fixed income markets. Bonds are indeed showing elevated levels of standard deviation, excess volatility, and that means bonds have slightly more volatility than most investors are typically used to seeing.
So can you give me your sober assessment as to where you think the Fed is headed here? Are we going to get two rate cuts before the end of the year, each 25 basis points?
That's our view as well. We expect 25 in November, 25 in December, as well as potentially more than 100 next year, 100 to 150 next year.
Wow.
So put that entire easing cycle together. That's about 250 bips of easing, going back to our first move in August. And that's in the middle of Fed easing. If you look historically, we've cut by more in the U.S. We've also cut by far less in the U.S. This actually feels like a pretty normal easing cycle.
So we've talked about opportunities in credit in the bond market. How are you feeling about the equity space against the backdrop of the Fed continuing to ease through the remainder of this year and, as you just kind of laid out there, into much of 2025?
It's a tailwind. The Fed is providing a tailwind to equity investors, and we are overweight equities in our multi-asset global portfolios. In particular, we like U.S. mega cap technology. I know those technology giants are expensive. I know the Magnificent Seven have run significantly, but that's an overweight, a structural overweight in our portfolios. And of late, it has continued to deliver the kind of performance patterns that we expect. I also note that outside of the U.S., we're overweight Japan across the DM complex, and we all like India within EM. India indeed has shown tremendous positive momentum, gaining over 40% in the last 12 months in dollar terms. That's been on the back of strong fundamentals, strong demographic story. That's been the more interesting space in the EM zone.
When you look at big cap tech, is there regulatory risk that we need to kind of expose a little bit here?
Yeah, there is regulatory risk. These giants are so big. I do note, again, 7 U.S. corporations have a market capitalization in excess of 15 trillion U.S. dollars. That is larger than, in fact, every single company in Europe combined, just in those 7 U.S. names. So to give your listeners a sense of the size of these firms. So the only thing big enough to kind of tackle these giants are, in fact, government. Now, you do note we're seeing some increased regulatory threats affecting the group, but do you know who I think that's a threat to? I think it's a threat perhaps to managers within those organizations. But in terms of shareholders, stockholders, I would argue that, in fact, any regulatory action that would move to break up one of the giants would just unlock value. So we continue to see opportunities for shareholders to invest and gain in the group.
How is the U.S. election entering your thinking, your analysis on how to deploy capital at this point in time?
We ran a bunch of stats to try to determine the statistical significance of election outcomes. We looked at historical Republican sweeps, historical Democratic sweeps, and we looked at both kinds of divided government. And by any statistical measure that we could use for significance, there is not a significant relationship between political outcomes and returns in the equity market. I note that, yes, while politicians are elected and while they do dictate what is the public policy, when it comes to trade policy, it's really more U.S. corporations than it is U.S. government that determines that trade policy. And the U.S. trade policy in a corporate sense is wide open for business. So I'm actually putting a pretty low amount of risk and stock into presidential election outcomes relative to our investment outcomes. We think the markets are in a good spot to continue to deliver. We think a soft landing can and happen. Putting that together with Fed easing, that's an environment where we can continue to deploy risk despite the noise coming from the elections.
So you mentioned trade there. I'm wondering how you're thinking about the notion of reshoring, bringing certain manufacturing back to North America from Asia, particularly Mexico. Is that a theme that you're looking at, that you're investing in?
Absolutely. The Mexican moment, as it is referred to in country, is a real thing. Principal has a great deal of operations in Mexico. I spend a lot of time in Mexico, actually. And what I do note is, one, you have a certain amount of political stability in Mexico. Despite some of the judicial reforms you've seen recently, you do have a certain set of expectations that have remained in place for some time, and that gives foreign investors at least some comfort and acknowledgement around what to expect. I also note that in our research, we are indeed seeing nearshoring happen. The price of industrial properties in the north of Mexico has begun to come up significantly. I also think that redundant supply chains, remember that was verboten for a long time in the industry. Redundant items are expensive, but you find American corporations are now willing to carry that, a little bit of extra expense to have a source in Asia for their critical inputs, as well as a source for those same inputs in our neighbor to the south.
Todd, enjoy your time in Hong Kong and the rest of the Asia Pacific during your trip. Todd Jablonsky is Global Head of Multi-Asset and Quantitative Investments at Principal Asset Management. Joining us now is Stephen Soon. He is Head of Research at HSBC Qianhai, joining us from our studios in Hong Kong. Stephen, good of you to drop by. I think we have to begin the conversation with China, especially since the market has been on a roller coaster ride since late September. There have been a series of measures unleashed by the government, a burst of optimism that quickly cooled. What's happening in your view?
We are first and foremost seeing a policy pivot. The policy pivot is a grand plan to first trying to engineer wealth effect in the stock market, as well as also stabilizing price in the property market, as a way to boost the confidence, especially for the Chinese household. The second step is clearly more fiscal stimulus in order to reflate the Chinese economy, help improve fundamental, and the last step of which is structural reforms to deal with the problems China is facing, from demographics to debt, insufficient demand, so on and so forth. The reason why we're seeing so much volatility in the market is because investors' view in terms of how to interpret whether these policies are sufficient, whether these policies will be effective, are widely divergent between onshore in China and offshore investors, between hedge funds and long onlys. And I would say, on the positive side of things, people view that, this time around, China is going to get things work. If not, and then more policies will keep on coming until it's working. On the negative side, there's also complaint. Oh, how come you're not giving me, the magic number? Why can't you just show me the bazooka, stimulus? Anything coming out is still viewed sort of incremental, not sufficient, lack of, shock and awe. So you got different opinions. That's why market volatility.
I'm wondering about the property market in particular. From what I understand, the housing minister later today will give a little bit more detail on measures to support the property market. This seems to be critical, right? I mean, it's something that can't happen simply with the flip of a switch, can it? This is going to make or take many, many years of process to unfold, right?
Exactly. Property is critical for Chinese economy. You cannot reinvigorate the economy without stabilizing property market. Directly, it's 8 to 9% of GDP, and indirectly, with both up and downstream, it's almost a quarter of China's economy. That's how important it is. And also from a fiscal stimulus perspective, if you want a fiscal stimulus to be effective, eventually that needs to the transmission mechanism needs to work through different sectors to create demand for credit and the credit cycle to lift economic growth. And the most critical sector is, again, still property. That's why you're seeing this press conference today. And to take a step back, this is actually not the first time for them to deal with property sector stimulus. If you can recall, back in the middle of May, that was the first massive round of property stimulus policy, followed by, on the 24th of September, what the PBOC has pledged to do, provide liquidity support for local government to acquire land reserves. And then today's conference, without knowing what's going to be discussed, I think the direction of travel is very clear.
I want to change gears and talk a little bit about deflation in China. I think at the factory gate level, at the wholesale level, China has been in deflation now for 2 years. Is your firm, HSBC, at all concerned that China, if it doesn't get this right at this moment in time, that it could kind of repeat what Japan went through 30 years ago, something that lasted multiple decades?
Okay, yeah. First of all, there are different metrics you can looking at. The one you referred to is PPI. It has stayed in negative territory, as I mentioned, for 2 years. But the other important measure for whether we're in deflation or inflation or disinflation, reflation, I think you should also look at the headline CPI number, right? As we speak, it's still in the positive territory. So regardless, I think it's not deniable that China is actually facing insufficient demand, and then that's why the fiscal stimulus is so important in order to pick up that filling that output gap, if you will. But all these are cyclical problems met with cyclical solutions. In the long term, right, over the long run, China definitely needs to unleash more structural reform, particularly on the household side. How do they improve the way for income distribution as a way to lift consumption as a percentage of GDP? And then on the private sector side, how do they reinvigorate animal spirits, entrepreneurship? That really is going to decide the future outcome, the future path. I don't think anything is set in stone yet, and then it's very convenient to compare China with Japan. There are similarities, but there are even more, differences. At the end of the day, I think it's the outcome still in the hands of the Chinese people, right? What exactly they're going to do in years to come.
That's a fair point. One of the bright spots of the Chinese economy has been exports. And one of the things that we're dealing with now in the U.S. is a presidential election that will happen in about 3 weeks' time, and the possibility that we will have a new administration that is much more aggressive on applying exports to Chinese goods. How critical would an outcome like that be for kind of really hampering the export sector in China and perhaps creating a stumbling block for growth?
Yeah, the U.S. election is still a very close call. I don't think we have any above market knowledge about the outcome. We would just have to wait and see what's the outcome, okay? And in terms of the impact for Chinese economy, for China's exports, for competitiveness of China's manufacturers, I don't think we should overplay impact from either Chinese or U.S. government in terms of policy. The reason being that from bottom up, the Chinese companies has becoming increasingly global, right? We published a thematic back in June talking about this ongoing trend. Give you some numbers, put that in perspective. For the top 300 Asia-listed company, we're talking about 10% of their revenue coming from overseas market, whereas industry leaders across the major sectors, EV and EV battery, medical equipment, construction machinery, consumer electronics, so on and so forth. We're talking about 30-40% of revenue coming from overseas market. However, that still has a very long distance to go if you compare it to global leaders in Japan, in Germany, in Europe. And certainly that's what the Chinese company are aiming for, right? They want to become global. They want to hedge their risk to a specific country's policy, to do R&D globally, to do manufacturing globally, to do marketing globally, and to sell globally, and then to become a truly global company, like most of those, S&P 500 company in the U.S.
I want to ask you about one industry in particular, only because we were talking in the last couple of days about this revelation from the chip-making equipment firm ASML that it will not make kind of the delivery target that analysts had been expecting. And we know that the export controls are in place from the United States in terms of trying to get companies like ASML to withhold certain advanced semiconductor technology to China. I don't want to talk about the impact as much as I want to know whether or not you see evidence that China is really able now to create its own semiconductor industry in a meaningful way. Are you seeing signs of that happening right now?
I'm not a tech analyst, so probably I cannot drill too much, into the details of technology. But having said that, at the 50,000 feet level, right, in terms of industry policy, in terms of the capitals pledged by the central government and the various local governments, I think it's enormous, right? You could argue whether that money it's the most efficient way to use or not, but the outcome so far has been quite amazing, right? For the stock market that I cover, China has set up this, star board in Shanghai, right? The number one sector, the sector with the biggest market cap, with the most IPO fundraising activity is in semiconductor. So admittedly, China would still be far lagging behind the top large technology developed in Silicon Valley and U.S. together with its allies. But in the next top large or above 14 nanometer, sort of 28, 22, even 56 nanometer technology space, certainly China is dominating, right? And those technology standards, I think, they're still contributing to the majority what, a piece of consumer electronics is going to, is going to use. Perhaps with the only exception being, in handsets or maybe in the most advanced AI algorithm calculation. But other than that, I see China make very steady and significant, inroads.
Yes, it was interesting today here in the U.S. We had a number of key lawmakers pushing the Commerce Department to try to prevent Huawei from making progress on its semiconductor manufacturing. Stephen, thank you so much for being with us. Enjoyed the conversation with Stephen Sun, head of research at HSBC Qianhai, joining us here on the Daybreak Asia podcast. Joining us now is Nupur Gupta, portfolio manager at Eastspring Investments, joining us from the Lion City of Singapore. Nupur, thank you so much for making time to chat with us. Can we begin by talking about what everybody has been discussing, this enormous rally that we had in Chinese equities, which appears to have faded? Do you have a sense of what's going on right now in this 10% pullback from the high that we had in early October?
Yes, good morning. So Chinese equities, of course, has been quite top of mind for all investors in Asia over the last 4 weeks. There has been a shift in the policymakers' intention, which is driving a lot of the investors to cover their shorts that have been in their portfolios for the last 1 to 2 years. So post-COVID, most of the fund managers didn't really bring Chinese equities up to overweights in their portfolios because of the uncertainty around the economic and the growth outlook. But over the last 1 month, they have been forced to cover some of that. The recent pullback has been partly driven by underwhelming follow-through from the policymakers in terms of fiscal support. So the market was really anticipating that in addition to the monetary stimulus that the Chinese policymakers were giving, they would also then support through the fiscal measures, particularly to revive the consumer sector. Because if you look at Chinese growth contributions over the last 1 year, you will see that it's mainly the consumption growth that is lagging, and youth unemployment is increasing, which is driving some of the deflationary pressures as well. So I think the recent pullback is partly an unwind of that expectation that the policymakers are really going to come in, pressing hard on the accelerator immediately. Mm-hmm. But now it's more a patient game where we try to, or at least markets are trying to recalibrate how much the policymakers are willing to push ahead.
So how are you feeling about not just China, but the overall global growth story?
So Chinese growth and global growth are quite decoupled now. So moving to global growth, from our perspective, we're still cautious. We recognize that the recent data prints out of the US in particular have surprised to the upside, and a lot of the narrative has shifted towards the fact that there might not even be a no landing scenario, let alone a soft landing. But from our perspective, all the micro data that we see in terms of, looking under the covers in the different sectors and even in labor markets, if you look at some of the regional data out of the US states, it's still suggesting to us that the weakness still remains. The consumption growth is, of course, quite strong, and that's really holding up the economy, and that's reflected in the services PMI readings. But the manufacturing sector is in contractionary territory, right? According to the Purchasing Managers Index. Particularly in Europe, we are seeing that even economic data is surprising to the downside, despite economists already downgrading their expectations. So labor market, manufacturing sector, still looking quite weak to us. And so we're a bit more cautious and taking all the recent upside surprises with a pinch of salt.
So what do you think the key here would be for European authorities, whether it's the ECB or based on a country-by-country basis, to create revitalization across the continent? What's going to be required?
So monetary policy is too tight. If inflation has come off as it has over the last couple of years, and if it stays at these levels, then real rates are tracking much higher than what they should be, which implies that overall speaking, the monetary policy is too tight for an economy that isn't very strong. So the first arrow really is to loosen monetary policy in a concerted and a confident fashion. So that means not only cutting rates, but also providing that dovish commentary to inform the markets that they are willing to do more if necessary. That's number one. Followed by that, any support given to consumption growth, either in the form of direct measures in terms of the fiscal policy, or indirect measures by reducing taxes or by improving liquidity, overall liquidity in the banking sector, can all help to revive growth in Europe.
Are you as cautious about the equity story in the United States?
We are more neutral equity story in the United States, partly because of the strength that we've seen over the last 1 to 1.5 months, particularly the earnings season that's been trickling through so far is still showing pretty strong corporate fundamentals. We're not seeing that in Europe, and so we're taking our more bearish views to the European part of the developed world. For the US, if we're very data dependent. Of course, we all know that it's extremely important to be nimble. The things that's keeping us neutral and not kind of overweight is because the cash levels from fund managers is really very low now, which means a lot of these fund managers are quite invested into the markets, and so positioning is quite stretched. Couple that with valuations that have been lofty for quite a while now, you really do need to see earnings growing at high double-digit numbers in order for us to even just sustain the SPX at where it is right now.
So as I'm listening to you, I'm thinking to myself, if you're really kind of neutral on equities and you're bearish on what's going on in Europe, China is not a growth story. You got to be in the fixed income space. Do you like credit right now?
Yes, absolutely. So from multi-asset space, I think credit is probably one of our strongest places in the economy. If you look at the corporate balance sheets in the US, whether it's investment grade or high yield, they're looking very strong. There was a time where the default rates were rising in the US, but you can see over the last couple of data prints that that's also rolled down, which means that the tighter monetary policy or the higher rates over the last couple of years has really not hurt the corporate balance sheets or margins much, which can be quite surprising to somebody who thinks about it from an economic fundamental point of view. But obviously, there has been other offsetting factors that are keeping the corporates quite strong. So corporate credit, both U.S. investment grade, U.S. high yield, and even in emerging markets, dollar bonds, we think are quite attractive to add carry to the portfolio with pretty minimal drawdown risk.
So as long as we're talking about fixed income, I think we have to include the Fed in the conversation. What's your view on the path forward for rate cuts?
We are still of the view that the Fed will continue to cut rates, but the pricing in the market for the next 12 months seems quite aggressive. And we believe that if it's inconsistent with what the market is expecting on the growth outlook. Because if the growth and labor market is indeed as strong as the narrative has moved towards over the last 1 month, even though that's not Eastspring's base case, if the growth outlook is indeed that strong, then there is no reason for the Fed to do the amount of cuts that's been priced in over the next 12 months. So my perspective is that we think the Federal Reserve will continue to cut rates, but if growth remains steady or slows down only marginally, then it won't be at the pace at which the market is pricing in.
Nupur, thanks so much for making time to chat with us. Nupur Gupta is portfolio manager at Eastspring Investments, joining us from Singapore here on the Daybreak Asia podcast. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.